Okay, so now we go to section 40, determination of amount and recognition of gain or loss. You take note of paragraph A and B. Okay, go there. This one, section 40. 40. This one, computation of gain or loss and basis for determining gain or loss from sale or disposition of property. Now, I want to discuss about these CIR versus fill invest. There's this case, I think this is the only case that I've encountered about the property for stocks. Because normally you recognize gain or losses for purposes of uh, the taxability of dealings on property. But whenever you exchange your property for stocks class, there is no gain or loss if the transaction is property for stocks. So you have this like building and you want to invest in a corporation in the stocks. You trade your building for the stocks of the company. So there is no recognition of gain or loss there, such that it is not taxable. The fill invest in this case, there are three companies here. We call them FDC, FAI, and FLI. Prior to the exchange, okay, of the properties for stocks, FDC holds 67.42% of FLI, a subsidiary, and it also holds 80% of FI, another subsidiary. Now, in 1996, FDC and FI exchanged some of their properties for shares of stocks of FLI. Okay, you have these properties. They exchanged that for stocks of FLI. Now, after the exchange, FDC only controls 61% of FLI, and FI now controls 9.96% of FLI, but FDC retains 80% of FAI. There is the controversy arose when the BIR started or it assessed the FDC for the exchange. It says it is taxable because you should recognize gain or loss. The issue there is on the provision, this provision, this one. No gain or loss shall also be recognized if property is transferred to a corporation by a person in exchange for stock or unit of participation in such a corporation, which as a result of such exchange, said person alone or together with others, not exceeding 4 persons, gains control of said corporation, provided that stocks issued for services shall not be considered as issued in return for property. Now, this phrase here, gains control of said corporation, the BIR, you did not, there is no control there. You already have control, okay? You did not take control of FLI because you already have control, such that it should be taxable. How did the Supreme Court rule on that? The Supreme Court said the paucity of merit in CIR's position is, however, evident from the categorical language of Section 34. This is on the 1993 NIRC, now Section 40, which provides that gain or loss will not be recognized in case the exchange of property for stocks results in the control of the transferee by the transferor alone or with other transferors not exceeding 4 persons. Rather than isolating the same as proposed by the CIR, FDC's 2 point, well, you just round this off, or 61% control of FLI's 4 million outstanding shares should therefore be appreciated in combination with the 420 million shares. Okay, well, this is 4 billion, I'm sorry. And new shares issued to FAI, which represents 9.96 control of the said corporation. But you just read this because this one, the issue there is, aside from the fact that on 10 September 2002, this decision in CTA case 6182 upholding the tax-exempt status of the exchange between FDC, FAI, and FLI was penned by no less than Justice Acosta himself. FDC and FAI significantly point out that said authors have acknowledged that the position taken by the BIR is to the effect that the law would apply even when the exchanger already has control of the corporation at the time of the exchange. This was confirmed when apprised in FLI's request for clarification about the change of percentage of ownership of its outstanding capital stock. Okay, you just read this. The idea here is even if you already have control, okay, of a certain corporation, and there is this again exchange of property for stocks, then that is still not subject to recognition of gain or losses because, as the provision states here, gains control of said corporation alone or together with others. So it still has the control. It doesn't really matter if you already have the control, but so long as alone or together, not exceeding 4, there are 3 or 2, well, in this case, there are only 2. And they still have the control. 61 plus 9, that's still a control over FLI. So that means the transaction is the transaction property for stocks. No gains or loss should be recognized. Okay, that's CIR versus Philinvest. And I hope you get the idea of this. Just remember, okay, the last paragraph of number or C, exchange of property, this one. Well, if you really don't understand this right now, you memorize this, okay? Just memorize this up to here. And, well, if the services is rendered in return for property or stocks, then it is not considered as a property, okay? So, that's for the Philinvest, PIR versus Philinvest. This was decided in 2011, and I haven't encountered any question about this one. This might be asked, and if that is the case, well, the question might be crafted in such a way that there are 3 companies, and one is a holding company or a parent company. The other ones are, well, the others are subsidiaries, and the exchange. So long as you still gain control, and that's it. There is no recognition of gain or loss. If there is no recognition of gain or loss, then there is no taxability. Okay. And remember the boot. Boot refers to the money and other properties received, even in excess of the stock or the securities given on the tax-free exchange. That is the term boot. Okay, and what are the others? Okay, that's section 40 for you. Just remember this. This and the last paragraph of paragraph C, exchange of property, this one. Okay, that's it. And we'll go to the other sections later.